Today, Axis with Kauser brings you the story of Wirecard, the billion-euro mirage, a lesson in governance, greed, and global oversight. In June 2020, the world watched in disbelief as 1.9 billion, yes, 1.9 billion euros simply vanished. Vanished, or they didn't exist to begin with. Wirecard AG, once Germany's poster child for innovation and fintech success, collapsed overnight. It wasn't just a corporate failure, it was a collapse of trust, governance, and regulatory oversight. This is the story of how a blue-chip European unicorn became one of the greatest financial scandals of the 21st century. Founded in 1999, Wirecard began as a small payment processor, helping online merchants accept credit card payments. At a time when digital transactions were exploding, Wirecard rode the wave, promising secure, cashless payments for a new world. By 2018, Wirecard had replaced Commerzbank in Germany's prestigious DAX 30 index, valued at over $24 billion. Its CEO, Markus Braun, was hailed as a visionary, a tech-savvy Austrian with a PhD in computer science, always seen in black turtlenecks, drawing comparisons to Steve Jobs. But behind the glamour, cracks were already forming. Wirecard's financial reports dazzled investors, record profits, year after year, expanding to over 26 countries. But much of this growth came from something called third-party acquiring. But what does it mean? It means that instead of processing payments directly, Wirecard relied on external partners, mostly in Asia and the Middle East, to process transactions on its behalf. These third parties supposedly generated massive revenues, but few outside the company had ever seen the evidence. Critics called it too good to be true, and they were right. Starting as early as 2015, short sellers and investigative journalists began raising red flags. But the real turning point came in 2019, when the Financial Times, led by reporter Dan McCrum, published a series of explosive stories. They alleged that Wirecard had been falsifying sales and profits, using fake clients and inflated balances in Asia to boost financial results. Instead of addressing the concerns, Wirecard fought back, accusing journalists of market manipulation and even getting German regulators, BaFin, to open investigations against the reporters. The watchdog was protecting the wrong side. In June 2020, Wirecard's auditors, Ernst & Young, EY, refused to sign off on the financial statements. They couldn't confirm the existence of 1.9 billion supposedly held in trust accounts in the Philippines. Wirecard claimed the money was in two local banks, BDO Unibank and Bank of the Philippine Islands. Both of these banks denied any connection. Days later, CEO Markus Braun admitted the unthinkable: the money likely never existed. The company's share price plummeted 90% in a matter of hours. It was the first time in German history that a DAX-listed company declared insolvency. At the center stood Markus Braun, the visionary turned villain. Arrested for fraud, market manipulation, and embezzlement, he maintains his innocence, claiming he too was deceived. Then there's Jan Marsalek, the company's COO, charismatic, mysterious, and allegedly connected to intelligence networks. When the scandal broke, he vanished. Last seen boarding a private jet to Belarus, he remains a fugitive, one of Europe's most wanted men. Meanwhile, EY, Wirecard's longtime auditor, was under fire for failing to detect the fraud, despite auditing Wirecard for over a decade. Critics argued that a simple balance confirmation could have exposed the scam years earlier. On June 25, 2020, Wirecard filed for insolvency, unable to account for billions. Investors lost everything. Banks and payment systems scrambled to unwind operations. Over 5,000 employees worldwide were left in limbo. In the months that followed, German prosecutors arrested several executives. The scandal triggered resignations, lawsuits, and intense scrutiny of Germany's financial oversight system. Wirecard wasn't just about fraud. It was a systemic failure of governance. The board of directors failed in oversight. The auditors failed in verification. The regulators failed in action. Even when red flags were raised, accountability mechanisms, both internal and external, chose silence over scrutiny. It was a wake-up call for the entire financial world. From the ruins of Wirecard emerged powerful lessons. Transparency is non-negotiable. Growth without governance is a ticking time bomb. Boards must challenge, not cheerlead. Independent oversight is only effective when truly independent. Auditors must verify, not trust. Technology and trust are no substitute for evidence. Regulators must act, not react. Protecting markets means protecting the truth, not the powerful. Investors must ask, what's real value and what's illusion? In 2024, Germany's APAS regulator, the Auditor Oversight Commission responsible for the supervision of auditors in Germany, ruled that EY committed grave violations in its Wirecard audits. And yet, in 2025, a German court absolved EY of direct liability to shareholders, sparking renewed debate over audit accountability. The story is still unfolding, but the message is timeless. In the world of finance, governance is not paperwork, it's protection. The Wirecard scandal reminds us that innovation without integrity is fragile. When numbers lie, even billion-euro empires crumble. Stay tuned for more stories from Axis with Kauser, where we decode real boardroom lessons from the world's biggest governance failures. You can also like and subscribe for more content on governance failures.